Okay, so what's our mission today?
Our mission is to derive and then fully utilize what's called the capital market line, or the CML. This line represents the new optimal path for any rational investor who can access both risky assets and a zero-risk option.
All right, let's unpack this. We should probably start where we left off with that curve foundation.
Yes.
We established the efficient frontier. That was the upper boundary, defined only by portfolios made of risky things, like stocks or mutual funds.
Exactly. That's the necessary starting point. When we were just looking at diversification among risky assets, we found that every single portfolio on that curve was the best you could do.
The best possible outcome.
The best possible. Each one offered the highest expected return, your E of RP, for a given level of total risk, sigma P. Before today, that curve was the absolute limit of investment efficiency.
Right. It was a trade-off. You wanted higher returns, you had to move up the curve and just accept more risk. But that whole thing was constrained by covariance.
Yeah.
By how assets move together.
Precisely. And now we introduce the factor that changes that entire constraint.
The risk-free asset.
The risk-free asset, which we denote as R sub F.
So in this academic context, what exactly defines RF?
Well, traditionally, you can think of it as a short-term government security, like a T-bill. But what really matters is the mathematical definition.
Okay.
Its variance, and therefore its standard deviation, is defined as exactly 0. Sigma F equals 0. It has, by definition, zero risk.
So if we're plotting this risk on the x-axis, return on the y, the risk-free asset just sits right there on the y-axis.
Exactly. Its risk is 0.
And adding an asset with 0 standard deviation, that just fundamentally changes the geometry of our efficient set. We're not stuck on that curve anymore.
We're not. We are now optimizing the combination of a zero-risk asset and a portfolio of risky assets. And that search for the optimum will always, always result in a straight line.
Okay, so we have RF sitting there on the y-axis. How do we find the one straight line that defines the new efficient set? Couldn't I just draw any line from RF to the old curve?
That is the central question the CML answers. And no, there is only one optimal straight line. Geometrically, you find it by drawing a line that starts at RF and extends out until it is precisely tangent to the original curved efficient frontier, just touching it at one point.
And that single point of tangency, I mean, that has to be the most important portfolio in all of financial theory, doesn't it?
It is, absolutely. We define that unique tangency point as the market portfolio. We call it M. M is the single, universally optimal, risky portfolio. It represents a combination of all available risky assets, stocks, bonds, commodities, everything weighted according to their market values.
So why M? What makes it so much better than any other portfolio on that original curve?
Because the line we draw from RF through M has the steepest possible slope. Mathematically, M is the portfolio that maximizes the Sharpe ratio, the ratio of excess return per unit of risk.
So it gives the most bang for your buck, risk-wise.
The most. So any rational investor should use M as their exclusive risky investment.
Hold on, let me just pause here to make sure we and you, the listener, really capture how revolutionary this is.
Please.
This model implies that every single rational investor, doesn't matter if they're aggressive or conservative, should only hold two things: the risk-free asset, RRF, and this single market portfolio, M. Is that right?
That is the core conclusion. It's often called the separation theorem. The decision of what risky assets to hold is settled. It's M. That's separate from the decision of how much risk to take.
Wow. Okay, and this straight line, the one that goes from RF through M and beyond.
That is what we formally define as the capital market line. It contains all the new, truly efficient portfolios.
So once you accept that M is the only risky game in town, your own personal risk tolerance just determines where you land on that line.
That's all it does.
Let's break down that spectrum then. You've got the part of the line between RF and M for, say, a low-risk investor.
Right. In that region, the investor is just mixing the two. They might put, say, 70% of their capital in RF and 30% in M.
And by holding RF government bonds, they're
lending money to the government. And their resulting portfolio risk, sigma P, will naturally be less than the market's risk, sigma M.
Makes perfect sense. You're diluting the market's risk with a zero-risk asset. But what about the investor who wants more? Who wants to get returns that are higher than the market's expected return?
To do that, you have to move past M on the CML. And that requires borrowing. It requires leverage.
Okay, leverage.
These are the high-risk investors. They commit more than 100% of their own capital to the market portfolio, M. They borrow money at the risk-free rate to amplify their investment in the market.
The idea of investing more than 100% can feel a bit abstract. Can we use a concrete example just with some numbers?
Of course. Let's say an investor has 100,000 shekels of their own capital.
Okay.
To get leverage, they go to a bank and get a loan for another 100,000 shekels. And the key assumption here is that the cost of borrowing is the risk-free rate, RF.
So now they have 200,000 to invest, but half of it is debt.
Exactly. They then invest that entire 200,000 into the market portfolio, M. They have moved way up the CML. Their expected return is now much higher than E of RM.
But
the corresponding risk, sigma P, is also amplified. It's much, much greater than sigma M. And the risk isn't just market volatility anymore. It's the risk that you don't earn enough to pay back your loan.
it's just fascinating how mathematically the only thing separating a conservative investor from a hyper-aggressive one is just the scale of their bet on M.
That's it. They both agree on the best risky portfolio. They just disagree on how much to allocate to it.
Right.
And so this geometric idea, it now needs a formal equation. We have to present the foundational equation for the capital market line.
This is the rule book.
This is the rule book. It dictates the exact reward to risk relationship for every single efficient portfolio on that line.
Okay, let's see it, and then we'll define every single term with precision.
All right. The CML is a linear model. It is. E of RP equals RF plus, then a fraction. E of RM minus RF, all divided by sigma M, and that whole fraction is then multiplied by sigma P.
Okay, that definitely looks like a straight line equation, your classic y equals c plus mx. Let's break down the symbols.
Perfect. Starting with the output, E of RP, that's the expected return of the specific efficient portfolio P that you're analyzing.
Got it.
On the right side, RF is the risk-free rate. That's your y-intercept, the return you get for zero risk. E of RM is the expected return of the market portfolio, M.
Right.
Sigma M is the standard deviation, the total risk of the market portfolio. And finally, sigma P is the standard deviation, the total risk of the portfolio P you are testing.
Now, if we just isolate the numerator of that big slope term, the part that says E of RM minus RF, what does that difference represent conceptually?
That is the market risk premium.
Okay.
It is the extra return the market demands just for moving off the risk-free asset and taking on the total risk of the market portfolio. It's the reward for taking risk.
And when we divide that premium by the market's total risk, sigma M, we get the slope of the line.
Yes. That entire fraction is the slope. You can think of it as the price of risk in this universe. It tells you exactly how much more return you should expect for every extra unit of total risk you take on.
And because it's linear?
Because it's linear, the portfolio's expected return increases in perfect proportion to its total risk.
Excellent. The theory is sound, the geometry is clear, the equation's on the whiteboard. Let's make it real. Let's run the numbers from our source material and see how this actually works.
Okay, let's establish our parameters. For these examples, we're given that the expected market return, E of RM, is 14%, or 0.14.
Okay, 14%.
The market standard deviation, sigma M, is 24%, or 0.24.
And the risk-free rate?
The risk-free rate, RF, is 4%, 0.04.
Great. Question 1. If an efficient portfolio is giving you a 16% return, so E of RP is 0.16, what must its standard deviation sigma P be?
Right, so we just plug the known values into our CML equation. We have 0.16 equals 0.04 plus our slope, which is 0.14 minus 0.04, divided by 0.24, all times sigma P.
Okay.
First step, let's subtract RF from both sides. So 0.16 minus 0.04 is 0.12. That's our excess return.
12%.
So now the equation is 0.12 equals the fraction 0.10 over 0.24 times sigma P.
So to get sigma P, we just rearrange the equation.
Exactly. We multiply 0.12 by the inverse of that slope. So sigma P equals 0.1, 2 times 0.24 divided by 0.10. And the calculated standard deviation is 0.28.
28.8%. So wait, the market portfolio's risk was only 24%.
Correct.
So the math here proves that to get that higher return, you had to borrow. The CML is telling you that if you want a 16% return in this world, you must accept 28.8% risk. There's no other way.
It's the mathematical proof of leverage. To move beyond M on the CML, you accept amplified risk. It's that simple.
Okay, now for the really critical part. Testing if a portfolio is efficient or not. Let's say someone brings us a portfolio. Portfolio X. It has a 20% expected return, but its standard deviation is 66%. Is portfolio X efficient?
Right. To test this, we use the CML as our benchmark, our ruler. We don't care about the portfolio's actual 66% risk, not yet. First, we have to calculate what the required risk should be for a 20% return if the portfolio were efficient, if it were on the line.
So we plug the 20% return back into the equation and solve for the risk it should have.
Exactly. So 0.2, 0 equals 0.04 plus our slope times what we'll call sigma p required.
Okay.
Isolate the excess return again. That's 0.16. So 0.16 equals the slope 0.10 over 0.24 times sigma p required.
And we solve for that required risk.
We solve for it. Sigma p required equals 0.16 times 0.24 divided by 0.10. The result is 0.384, 38.4%.
Okay, this is the moment of truth. The CML, the law of the land, says that for a 20% return, the risk you should be taking is 38.4%.
But the portfolio we were given, portfolio X, has an actual risk of 66%.
66% is way, way higher than 38.4.
It's dramatically higher. So the final verdict is unequivocal. Portfolio X is inefficient.
Inefficient.
Geometrically, it lies far below the capital market line. It is taking on almost double the amount of risk that is necessary to get that level of return. It is a poorly constructed portfolio.
So this all brings us to the ultimate final rule. How do we define efficiency in this new world with the CML?
The rule is absolute. A portfolio is efficient if and only if it satisfies the capital market line equation, meaning it lies directly on the CML.
And if it's not on the line?
If it's below the line, like our example, it's inefficient. If you find a portfolio above the line, well, that's theoretically impossible in an efficient market. It would be a free lunch.
This has been an incredibly precise and necessary deep dive. We've shown how introducing a risk-free asset simplifies portfolio choice, moving us from a complex curve to a simple line. We've defined the universally superior market portfolio, M, and we've explained the entire rational investment spectrum, from lending all the way to aggressive leveraging.
And just to reiterate that one single takeaway, the capital market line defines all efficient portfolios when a risk-free asset exists.
Okay, so a final provocative thought for you to take away. The CML works beautifully because it uses total risk, sigma, which is the right measure for a well-diversified portfolio. But what happens when you try to analyze the risk of a single stock? A single stock is almost always inefficient by itself. It falls way below the CML. So if you can't judge an individual stock against the CML's definition of total risk, how do you break that risk down? How do you figure out how that one stock contributes to the risk of the overall market portfolio, M? And that question, that is the conceptual bridge that takes us to our next deep dive.